Hello students, today I am going to take up the part B of your business studies, and in this our first chapter is financial management. My dear students, you have learned in class 11th about the finance, sources of finance. I will still recapitulate here about the term finance. Money is required to carry on the business activities. So this money required to carry on the business activities is known as business finance. Almost all business activities require finance. Finance in business is required to establish it, to run it, to diversify it, to modernize it, to expand it, and to acquire assets. Assets which may be tangible and intangible. Tangible assets such as plant, machinery, building, etc. And intangible assets include patents, copyright, technical expertise, etc. So what is financial management? So here we can say it is something related to this finance. Exactly, it is defined as planning, organizing, directing and controlling the financial activities of the business. So it aims at procuring, allocating, utilizing the funds in the organization. So the aim of the financial management is to reduce the cost of the procured funds and keeping the risk under control and effective deployment of such funds. Here the aim of the financial management is to make the funds available whenever required and helps in avoiding the ideal finance. So this was about the meaning of financial management. Coming on to the objectives of financial management. What is the objective? The main objective of the financial management is the wealth maximization, is to maximize the wealth of the shareholders, for which the achievement of optimum capital structure and the proper utilization of funds is a must. This is the main objective of financial management. The other supporting objectives include to procure sufficient funds for the organization. Adequate and regular supply of funds are to be maintained for the smooth functioning of the enterprise. The next is to ensure effective utilization of funds. Then to ensure safety of funds. The chances of risk in investment should be minimum possible. And the last is to meet the financial commitments with creditors. Financial management ensures that the creditors are paid on time. So we can say that it is concerned with the procurement, the utilization and allocation of funds. So in this financial management, there are three areas for decision making. The first one is investment decision. Next is financing decision, and the third one is dividend decision. What is investment decision? It is related to the firm's decision regarding how to invest the funds in various assets. There are two decisions involved here. The first is long-term decision, which is also known as capital budgeting decision, because here huge amount of funds are invested. They are irreversible except at huge cost. And next is short-term decision, or we can say the working capital decision. Working capital decision which affects the day-to-day functioning of the business. Factors affecting capital budgeting decision. The first is cash flows of the project. The cash receipts and the payments over the life of the investment proposal should be taken into consideration. The next is rate of return. The rate of return on the investment proposal and the risk associated with the investment proposal should also be taken into consideration. Then the last one is investment criteria involved. So these investment proposals are evaluated on the basis of various capital budgeting techniques, which involve calculation of investment amount, rate of return, cash flows, and interest rate, etc. So this was about the investment decision. The next is financing decision. This financing decision relates to the decision of the firm from which the funds can be raised, because there are two main sources of raising the funds. The first one is owners fund, which is also known as equity or shareholders fund, and the next is borrowed funds, which is also known as debt funds. Borrowed funds, or we can say the debt funds, these here the capital amount is repaid at a fixed time and there is a payment of interest at regular intervals. So we can say there is a financial risk, the risk of default in the payment, and the interest on these borrowed funds are paid regardless of whether or not the firm has made the profit. But on the other hand, the owners funds, which is known as equity funds also, there is no commitment regarding the repayment of capital amount and the payment of returns. So the firm has to decide about the mix of both equity and borrowed funds. There should be a proportionate amount of both equity and borrowed funds. Now, what are the factors which affect the financing decision? The first one is cost. The cost of raising the funds from different sources are different. So the cheapest source should be selected. Then the risk associated with these sources of funds are different. So more the risk, less attractive will be the investment. Then flotation cost. Flotation cost is the cost incurred on issuing the securities, such as broker's commission, underwriter's fee, expenses on issues. So these are the flotation cost. More the flotation cost, less attractive will be the investment. Then cash flow position of the business. In case the cash flow position of the business is good enough, so they should raise the funds from debt sources, from borrowed funds, because they can pay the returns easily. The next is control consideration. If the existing shareholders want to retain the control over the business organization, then the funds should be raised through borrowed funds. But if they want dilution of control, then we can issue equity funds. Next is state of capital market. During boom, the funds should be raised through equities, and during depression, the funds should be raised through borrowed funds. Next is period of finance. For permanent capital requirement, equity shares should be issued because we don't have to pay the capital amount and the return. But if the requirement is for short and medium term, then debt or borrowed funds should be raised. So this was about the financing decision. Coming on to the next, we have dividend decision. Dividend is that part of the capital which is distributed among the shareholders. A firm should decide how much to retain and how much to distribute as dividend among the shareholders. So this dividend decision are affected by number of factors, and the first one is earnings. Because dividend is paid out of past and current earnings. So when there is high earnings, the firm can declare dividends. The next is stability of dividends. As the firm follow the stable policy of dividend, then the dividend per share is not altered if the earnings increase proportionately or there is a increase which is of temporary nature. Then the next is growth prospects. If there is a growth prospect for the firm in the near future, then they should retain the dividends. No or less dividends should be declared. Then cash flow position. When we declare dividend, there is outflow of cash. So when the cash flow position of the firm is good enough, then they should declare dividends. Then the next is preference of shareholders. Preference of shareholders should also be taken into consideration. If the shareholders want dividend, then we should declare the dividends. If they want the company to retain, then we should retain the dividends. The next is taxation policy. A company is required to pay tax on dividends. So when higher rate of tax is there, then less amount of dividend should be declared. When lower rates of tax is there, then high amount should be declared as dividend. Then issue of bonus share. A company sometimes issue bonus shares in order to increase their capital base. It also signifies the growth and also the reputation of the firm enhances. Next is legal constraints. Under the provisions of Companies Act, the company should not declare all the earnings as a dividend. They should retain some amount in the form of reserves. So this legal provision also restricts the capacity of the company to declare the dividends. With this, we have completed the 3 decision-making areas. The first is investment, second is financing, and the third is dividend. Hope you have understood this topic. We'll see you in the next video. Till then, take care. Bye-bye.